Hi guys, this is Erica from Gokce Capital. Now before I begin, be sure to click subscribe and turn on the notification bell. Here's a question for you. If most mortgages are insured, why did so many banks collapse during the 2008 crisis? We'll learn the answer at the end of this video. But first, if you take out a mortgage, chances are you will need private mortgage insurance. And in today's video, we have the top things you should know. Number 1. What is private mortgage insurance? Private mortgage insurance, also known as PMI, is a type of insurance policy that protects a lender if a borrower defaults on a home loan. Now, it's important to note that this insurance benefits your mortgage lender, not you. Thus, if you default, the mortgage insurer will cover a portion of the balance due to the lender. Number 2. When is private mortgage insurance required? Loans guaranteed by the government, that is, those loans that are sold to Freddie and Fannie Mac, require PMI if you put down less than 20%. Number 3. Who pays for private mortgage insurance premiums? Well, you do. Even in those loans where the lender pays the PMI premium, you will find that the cost has been factored in, usually in the form of higher interest rates. Annual premiums typically range from 0.3% to 1.5% of the original loan, but what you will pay depends on the loan-to-value ratio, as well as your credit score. Number 4. What are the different ways to pay for private mortgage insurance? The most common way to pay for PMI is with monthly payments that are added on to your principal and interest. But you also sometimes have the option of bundling the entire cost of PMI into one payment made up front. Number 5. When can you stop paying for private mortgage insurance? Once your balance hits 78% of the original loan amount, your mortgage servicer is legally required to stop charging PMI. But if your home value has gone up, you can get a new appraisal which shows that the loan balance has gone below 80% of the current market value and apply for early cancellation. And number 6, is mortgage insurance for FHA loans the same as PMI? No. Mortgage insurance works differently with FHA loans. FHA mortgage insurance premiums are sometimes lower than PMI, but in the long run they will cost you more, as you cannot cancel mortgage insurance with FHA loans. But now that we've covered the basics of private mortgage insurance, let's return to our opening question. If private mortgage insurance protects banks from losses during a foreclosure, why didn't it stop the 2008 financial collapse? Well, for one, PMI doesn't cover the full value of a mortgage. So in a crisis at the scale of the 2008 collapse, even mortgage insurance may not have been enough to keep the banks afloat. But it didn't help that most subprime loans didn't even have insurance. One thing you may not know is that PMI companies must place half of their premiums in a reserve that cannot be touched for 10 years. This means they don't have the same incentive as lenders to increase their profit by taking on more risk. Thus, in the wild years of the aughts, most private mortgage insurance companies stuck to their guns and declined to insure a large portion of the riskiest loans originated at the time. This left lenders with two options: originate less risky loans or forgo mortgage insurance. I think we all know which they chose. As it turns out, many conventional lenders found a workaround in the form of a piggyback loan. A piggyback loan is a second mortgage that covers the difference between a buyer's down payment and 80% of the home's value. So, for example, with an 80-10-10 loan, 80% of the purchase price is covered by a traditional first mortgage, 10% by a second piggyback mortgage, and 10% by your down payment. Buyers loved this because the interest on the piggyback loan was usually less than private mortgage insurance premiums. Plus, the interest payments were tax deductible. The problem was these loans often came with a variable interest rate. So while they started out affordable, once the rate went up, many borrowers found they could no longer afford the loan and fell into foreclosure. When home prices plummeted and foreclosures skyrocketed, the piggyback loans were simply wiped out, leaving the original lenders underwater. This is why PMI is so important. It serves as a backstop to the complete collapse of the housing market. Of course, as a buyer, it makes the most financial sense to simply put 20% down. But if this is not feasible, beware of any loan that tries to work around PMI. It may be more affordable at first, but in the long run, it could cost you dearly. But what do you think? Do you have any stories about private mortgage insurance? Let us know in the comments. Did you like this video? You're going to love our Gokce Land Due Diligence program. We'll make you a land due diligence expert in just 7 days. Check it out at gokcecapital.com/glad. And while you're at our website, don't forget to explore our $1 down properties at gokcecapital.com/listings. Finally, don't hesitate to reach out. You can email, call, or text, and we will respond as soon as possible. So thank you for listening, and more to come.